Welcome to Global Wealth Forge, where we empower you to take control of your financial future. Today, we delve into the cornerstone principles of investing with a comprehensive exploration of Rule #1. The insights we're about to share stem from the wisdom of Phil Town, an investing powerhouse who penned the book Rule #1. Town's book is a beacon of financial enlightenment, illuminating the path to wealth creation by borrowing from the legendary investor Warren Buffett's playbook. So, what's this Rule #1 all about? It's surprisingly simple yet profoundly impactful. Don't lose money. Yes, that's it. This fundamental principle underscores the importance of protecting your hard-earned cash. In the words of Buffett himself, the first rule of investing is not to lose money. And the second rule is, well, to never forget the first rule. How do we adhere to Rule #1? Town suggests the concept of a margin of safety. This involves doing your homework, understanding the intrinsic value of companies, and only putting your money on the line when the stock price is significantly lower than that value. But it's not just about picking undervalued stocks. Town also stresses the virtues of patience and discipline. It's about waiting for the right opportunities to come along and not getting swept away by the ebb and flow of the stock market. In the grand scheme of investing, maintaining a long-term perspective is crucial. By sticking to this approach, investors can ride out market volatility and reap the rewards of compound growth over time. This long-term vision involves investing in companies with durable competitive advantages and predictable earnings. To top it all off, Rule #1 encourages investors to be perpetual students of the market. The more you learn, the more equipped you'll be to make sound investment decisions and adapt to the ever-changing financial landscape. In essence, Rule #1 lays a solid foundation for successful investing. It champions capital preservation, patience, continuous learning, and a long-term outlook. By embracing these principles, you can confidently navigate the intricate world of investing and set the stage for enduring wealth creation. This fundamental principle emphasizes the importance of preserving capital. According to Buffett, the first rule of investing is to avoid losing money at all costs. To abide by Rule #1, Town suggests employing a margin of safety when investing. This margin of safety is a crucial buffer that protects your investments from unforeseen downturns and market volatility. But what exactly does it mean? At its core, the margin of safety is a principle that involves buying stocks at a price significantly lower than their intrinsic value. It's like purchasing $1 for 50 cents. It's a technique that provides an investor with a cushion against errors in their valuation calculations and unforeseen market events. To effectively employ a margin of safety, it's imperative to have a deep understanding of the company you're investing in. This means conducting thorough research into its financial health, business model, competitive landscape, and management. But how do you determine a company's intrinsic value? Well, it's not just about looking at the numbers. It's about understanding the company's story, its competitive advantages, and its growth potential. It's about assessing the quality of its products or services, its customer loyalty, and its ability to innovate and adapt to changing market conditions. Once you've determined the intrinsic value, the next step is to wait for the right opportunity to invest. This is where patience comes into play. The stock market is unpredictable and prices can fluctuate wildly in the short term. But if you've done your homework and you're confident in your valuation, you can wait for the price to dip below the intrinsic value before you make your move. This approach requires discipline and patience, but the rewards can be substantial. By investing with a margin of safety, you're not just protecting your capital, you're also setting yourself up for potentially higher returns. It's a strategy that stood the test of time and is a key component of Rule #1 investing. So remember, to abide by Rule #1 and avoid losing money, it's crucial to employ a margin of safety when investing. This involves thoroughly researching companies, understanding their intrinsic value, and only investing when the stock price is significantly below that value. Town emphasizes the power of patience and discipline in waiting for the right opportunities to invest. Patience in this context is not about inaction. Rather, it's about the strategic waiting for the right time to strike. It's about understanding that sometimes the best action is no action at all. Consider the stock market as a vast ocean. You, as an investor, are a fisherman waiting patiently by the shore. You don't cast your net at the first sign of movement in the water. Instead, you wait, you observe, you study the patterns, the tides, the weather. You understand the best conditions for a good catch. And then, when the time is just right, you cast your net. This is the essence of investing with patience. It's about resisting the urge to jump at every opportunity that comes your way. It's about understanding that not every fluctuation in the market is a signal for you to act. It's about learning to be comfortable with waiting, with observing, and with biding your time. In the world of investing, patience is indeed a virtue. It's the ability to resist the allure of short-term gains in favor of long-term wealth accumulation. It's the fortitude to stay the course even when the market takes a temporary dip. It's the wisdom to know that true wealth is built not in days or weeks, but in years and decades. But patience, as Town reminds us, should not be confused with complacency. As investors, we must always be learning, always be observing, always be ready to act when the right opportunity presents itself. We must be patient, yes, but we must also be alert, informed, and prepared. And so the power of patience in investing lies not in the waiting, but in what happens during the wait. It's in the learning, the observing, the preparing. It's in the understanding that investing is a long game, and that the most successful players are those who know how to wait for the right moment to make their move. He advocates for a long-term approach, focusing on the quality of the businesses rather than short-term market fluctuations. Furthermore, Rule #1 encourages investors to constantly educate themselves and stay informed about the market. Just as an athlete trains to enhance their performance, an investor must also exercise their mind to stay ahead of the game. Education in this context is not a one-time event, but a lifelong process. It's about understanding the dynamics of the market, comprehending financial reports, and staying updated on global economic trends. In the world of investing, knowledge is power. It helps investors decipher the intricacies of the market, recognize valuable opportunities, and make well-informed decisions. It's not just about knowing what to invest in, but understanding why you're investing in it. This comprehension builds confidence and enables investors to remain calm during market fluctuations, reducing the likelihood of panic-driven decisions. Moreover, continuous education helps investors adapt to the ever-changing market conditions. As the global economy evolves, so does the market. New sectors emerge, old ones decline, and economic policies shift. For instance, the rise of technology companies in the past 2 decades has transformed the investment landscape. Without the willingness to learn and adapt, an investor might have missed this significant opportunity. Education also helps in understanding and interpreting financial news and analysis. The financial world is a cacophony of information with countless data points, opinions, predictions, and analyses. Without a solid educational foundation, it can be overwhelming and confusing. But with knowledge, investors can discern valuable insights from noise and make decisions based on rational analysis rather than emotional reactions. In addition, continuous education fosters a mindset of curiosity and open-mindedness. It encourages investors to question, explore, and seek out new ideas. This intellectual curiosity can lead to innovative investment strategies and the discovery of hidden investment gems. In essence, Rule #1 sees education as an essential tool for successful investing. It's about empowering investors with the knowledge to navigate the complex world of finance confidently. Continuous learning is key to making informed investment decisions and adapting to changing market conditions. In conclusion, Rule #1 provides a solid foundation for successful investing by prioritizing capital preservation, patience, and continuous learning. We've journeyed through the landscape of finance today and found that this rule, simple as it may seem, is a beacon of wisdom for the savvy investor. Let's recap our journey. We started with the fundamental principle, "Don't lose money," a mantra that underscores the importance of safeguarding your capital. It's not about playing it safe, it's about playing it smart. It's about understanding the intrinsic value of a business and knowing when to invest based on that knowledge. Then, we delved into the concept of a margin of safety. This is a principle that encourages us to invest only when the price of a stock is well below its intrinsic value. It is a strategy that requires discipline and patience, but it is a proven method to mitigate risk and increase potential returns. we also explored the power of patience. In the world of investing, haste can often lead to waste. Rule #1 teaches us to wait for the right opportunity, to focus on the long-term potential of a business rather than the short-term market fluctuations. It's about understanding that wealth accumulation is a marathon, not a sprint. And finally, we discussed the importance of continuous learning. The world of finance is ever evolving, and staying informed is key to making sound investment decisions. Rule #1 encourages us to be lifelong learners, to continuously educate ourselves about the market and adapt our strategies accordingly. So there you have it, a closer look at Rule #1. But remember, this is just the beginning. Financial success is a journey, and each step, each rule, is a building block towards your financial freedom. Thank you for joining us on this journey to financial empowerment. Don't forget to like, share, and subscribe for more insights on building wealth. Until next time, keep forging your path to